All right, good morning. It's 11 o'clock, and I know we still have attendees that are logging in right now, but I'd like to go ahead and get started so we can keep the program running on time this morning. So welcome to Briggs & Veselka's Nonprofit Bootcamp, our lunch series. We're doing something different this year by having our lunch and learn today and tomorrow. And for those of you that I have not met, my name is Deborah Seefeld. I'm an audit partner with Briggs & Veselka, and I lead the nonprofit practice group here within the firm. Our nonprofit professionals across audit, accounting services, and tax, we service over 300 tax exempt engagements each year. So our intention when we put this program together was really to bring together leaders within the nonprofit sector. Those within the CPA profession and those that actually are working in nonprofits themselves or advising nonprofits who really can share their stories and lessons learned to benefit not only our nonprofit clients, but really the larger nonprofit community as a whole that our communities serve. We know in serving our nonprofits that whether you're a small nonprofit or a large nonprofit, many of the challenges are really the same. Best practices in board governance, volunteer engagement, staying on top of the accounting and auditing standards that are forever changing, just to name a few. So we're glad you're here today. We've put together again a series of these topics and others that we're going to cover today and tomorrow. And our hope is by covering some of these technical and not so technical topics that each and every one of you, whether you're a board member or whether you're an accounting professional, take things back to improve and better serve your organization and those that your organization serves. So I do have a script of some housekeeping tips that we need to cover before I introduce our first speaker. We will have polling questions that will be running throughout the boot camp. So for those of you that are interested in receiving continuing professional education credit, CPE credit, today's boot camp will be worth 1.5 credit hours and tomorrow the same. You will need to answer those polling questions in order to earn CPE. If you are not seeking CPE credit, feel free to participate and just for the fun of it, and again, participate in that polling. We have muted the attendees, so we're asking if you can submit any of your questions for our speakers in the Q&A section of the Zoom webinar tool. I think we're all getting much more used to using the chat feature and the Q&A. So for your questions, please use the Q&A and not the chat feature. And we'll try to cover questions as we conclude each section along the way today. We are recording the presentation, and after we finish up the boot camp tomorrow, we will be emailing out the materials and recordings to participants for you to have also. And lastly, before we get started, please mark your calendar for tomorrow for 11 to 12:30, same time, same place, as we'll complete day 2 of the boot camp tomorrow at lunchtime together. So sit back, enjoy your lunch, and I'd like to now welcome and introduce Noel Kersh to the stage. So Noel, thank you for being here today. I have known Noel for a number of years. I'm so glad he was willing to spend time with us today. Noel is the managing principal of Pathway Forensics, which is a subsidiary of Briggs & Veselka. He has a very interesting background, but I'll just summarize by saying he has extensive experience in conducting digital forensics, acquisitions, and analysis on a variety of cases. Some of these cases may involve business and employment disputes, compliance with discovery requests, family law, unfortunately harassment, in-house investigations for corporations, copyright infringements, and even criminal cases. So Noel has worked on behalf of several nonprofits to conduct investigations to determine if money was taken from the organization. He even assisted a nonprofit with preserving some data that was later used in a capital murder case. All jokes aside, Noel has stories to tell. In Noel's session today titled Wise or Otherwise, it's your choice to protect your organization to manage cyber and IT risks. Noel, the stage is all yours. Thank you for being here.
Absolutely. Thank you, Deborah, for having me. Appreciate the opportunity to speak to all of you today about a topic that's that affects everybody, every organization, despite whatever size you are. If you're a small nonprofit, if you're a large nonprofit, you have data and you have computers. If you don't, well, then kind of weird that you're on this webinar. But anyway, so I think everybody's got some data needs to be protected. And so really, I'm going to be talking about managing the cyber and IT risk for your organization. I'm going to be focusing on really trying to address these 4 questions. The first is, what are the current threats to my organization's data? Then I'll talk about what are some steps that you can take to protect your organization. And then I'll go into how can I figure out if my organization is at risk? And then why use digital forensics when I have an IT department? And so Deborah was talking about my role here is I'm a managing principal here at Pathway Forensics. We are a subsidiary of Briggs & Veselka. So my practice has cybersecurity. We also do digital forensics. So we kind of do a little bit of everything. So I'm going to kind of talk about both cyber and digital forensics today. So first question, kind of diving into what are the current threats to my organization's data? And so what I put together is just sort of 5 of the top current threats to organizations in 2021. So I'm not going to go into great detail about each one of these, but really these are the main threats to everybody. The first one is social engineering. So 1/3 of the breaches in 2021 used some sort of social engineering to infiltrate an organization. 90% of those utilize phishing emails. And so phishing emails, if you're not familiar with this, is an email that you get that looks like it's coming from somebody within your organization or somebody that you do business with that is seems legitimate. Like the message seems like it's got something to do with my work, or maybe you get an email from that Nigerian prince saying, hey, I've got all this money that I want to send to you. That is an example of a phishing email. And the danger there, obviously, and the reason that works so well is people just click on things without really thinking first. And so one of the best methods for protecting your organization is just instilling some awareness about cybersecurity, because the front lines are your employees, are your people within your company. All it takes is one person to click on one of those links and bad things happen. And those bad things can be anything from malware getting installed on the person's computer that clicked on it that starts doing other evil things within your organization. It could also be a spoofing email that looks like a legitimate invoice that isn't, and you transfer money to a company that is run by hackers. So all those types of things are kind of fall underneath that social engineering umbrella, and they're very effective, unfortunately. I'll talk in the next slide about some things that you can do to protect yourself from that. Ransomware. If you've probably heard this, and I don't know if you know what this is, but basically it is hackers infiltrating your network and then taking your data ransom. So what they do is they come in and they encrypt your data. It could be your computer, could be if they make it into your network, they could be encrypting your email server. We've seen backup servers also encrypted. So they come in as they encrypt everything, and then they demand a ransom to get that information back. Very expensive. Hackers know that there is a lot of value to your data, and they will take it, and they will demand a lot of money because they know that people will pay it. And it's very effective, so they keep doing it. One of the really bad things we've started seeing lately is that it's moved on from ransomware attacks have moved on not only from companies, but they moved to individuals where they infiltrate people's home computers, and they take ransom all of their home pictures, or they find where they're keeping all of their pictures and videos of their kids. They know how important that is to people, and so they're taking that information ransom and requiring ransom to be paid before you can get access back to your data. So it's pretty bad, obviously. But that is something that they're doing lately, which is kind of annoying. But just to let you know that's something that impacts everybody, not just you at work, but at home as well. DDoS attacks, this is sort of a lesser thing that happens. But for companies, what this is just a flood of requests to a server with the intent of bringing that server down. That happens quite a bit. If you were on Facebook a couple weeks ago or a week ago, I can't remember, and Facebook went down. This is one of the attack methods that was used to bring Facebook down, was they just overwhelmed their servers and brought them down. So that's a vulnerability. The other one is cloud computing misconfigurations. Sometimes put information out there, they're looking for any way to get access to your cloud computing environments. And cloud computing companies do have a lot of security, but the problem is it only takes one infiltration of a network to gain access to multiple companies that store their information on that cloud computing platform. And then third-party software. I'll give you an example of this, the Apple vulnerability on phones, which I'll talk a little bit more about later. If the software running on the iOS that's running on your phone had a severe vulnerability in it, sometimes those things get infiltrated, and all phones that are running that operating system can be at risk as well. So moving on to what are some steps that I can take to protect my organization. So how can you start to go on the offense here and protect yourself? So you're in luck. October happens to be Cybersecurity Awareness Month. So my advice is to start doing something now. If you don't have anything, if you don't know what your cybersecurity program is, or not aware of what you're doing, or if you're relying on your IT department to take care of you, might want to have somebody like my company come in to just talk with you and kind of help you do an assessment of what you actually have. We can talk about email phishing campaigns. These are some things that you can do. We have this at Briggs & Veselka, where we have a program that sends out phishing emails. They're ones that we make up, but they simulate real phishing emails, and we just see, okay, who's clicking on stuff, where do we need to do retraining of our staff to make sure that they understand, can identify phishing emails and stop clicking on stuff. So other things are posters, town hall meetings. Like I said, awareness really is the best training for protecting you from being vulnerable to these kind of attacks. And actually, Pathway, we have these nifty little posters that we put together that you put on your desk, and it's got this one says the top ransomware best practices. And it's just some simple things. We have some other things that we can do, like mouse pads, posters, all that kind of stuff that we can provide to you. If you'd like that, let me know, or somehow get in touch with me, and I'll get you those types of tools. Real simple things. It just kind of, again, it's to raise awareness and keep cybersecurity kind of at the front of people's minds in your company. It's the best defense. And then the other thing is just understanding the scope of what you have, doing a risk assessment, which risk assessment is really just having somebody come in, doing a program, or having a company like Pathway or another company come in that just sort of looks at, what are you doing? What do you have to protect your company? And they give you a list of things that you can do better, and then kind of put together, if you'd like, a plan to help you kind of bolster your defenses a little bit. So the other thing is, or the next question is, how can I figure out if my organization is at risk? Excuse me. So one of the good things that came from COVID is it kind of was a training of everybody on QR codes. Before COVID, QR codes were like this space technology nobody really understood and had to be explained to them by their teenagers. Now everybody, if you've ever gone to a restaurant during COVID, you understand what a QR code is. So take out your phone, use the camera, and scan this. And what this is going to take you to is Pathways put together. It's a free B&V Cybersecurity Threat Assessment. And all this is, it's 13 questions. And the intent of this is to not to sell you something. We're not going to put you on a list and bug you. All this is it asks you 13 questions about your organization. And it just asks you about 13 different components of a good cybersecurity program. And you answer them either yes, no, or I don't know. If you don't know if you have this particular defense mechanism in place, well, then answer it that you don't know. And what's going to happen after you submit is you're going to get a response from us. It's automatic. It's going to come right back to you, and it's going to tell you just in general terms kind of how you scored. And then beyond that, what's going to happen is I'm going to have my director of cybersecurity, his name is Mike Tripkosh. Mike is going to look at your responses and then send you an email that says, hey, I looked at your survey and I'm giving you, here's some little tidbits, here's some advice and everything. Again, this is all free. You're going to get my director of cybersecurity kind of weighing in on what he sees as your organization's vulnerabilities. So this is a free thing that we do. Again, it's to connect us with you. So that's the upside for us, is that we get to connect with you. And then the upside for you is that you kind of get a sense of where you are as an organization, what your threat level is. So it's a little tool that we threw in there for you. Now, while you still have your phones out, I mentioned earlier about the third-party software vulnerabilities. One of those is Apple iOS. The operating system that runs on iPhones is called iOS. A few weeks ago, or actually a month ago now, there was a major vulnerability that was identified in iOS. And so if you would follow me on your phone, go to Settings, and then go to General, and then go to About. If the software version, which is the second line on there, on that thing that comes up, if the software version is earlier than 15.0, back out to General, and then go to Tap Software Update. And it'll update your operating system to the current version. Version 15, earlier than 15.0, had a security vulnerability in it that would allow your phone basically to be spying on you, and that information to be sent out to hackers. So just a little thing it kind of threw in there just for attending today. So question 4 is, why use digital forensics when I have an IT department? This is something that I get hit with all the time. People wonder why, hey, I've got an IT department, they're going to take care of me. Digital forensics can really help you with all these things. If they're internal investigations, we're an independent third party. We can help you. Computer use violations, like I said, Deborah alluded to, I've worked with companies that have had data stolen from them, worked with churches that have had data stolen from them, and so on. So, and had money stolen from them. So we conduct those types of investigations, and really just in broad strokes here, there's more training that we've had in those areas than in a typical IT department. I included some do's and don'ts on the following slides. Unfortunately, I'm running out of time, so I'm not going to be able to hit on all these, but in general, these are things to do and things not to do. The main thing I want you to take away from this is when there is when you think there might be a need to do an investigation within your company, if you think something bad may be going on, send that computer to a digital forensics company first to have it preserved. Don't send it to your IT department and have them start running reports, connecting USB devices and doing things on it, because what that does is it changes the evidence. So kind of it'd be akin to, and actually like an hour ago, I had an IT director from one of my clients, new client, call me and say, hey, before I send this laptop into you, I want to let you know that we ran some diagnostic reports on this. I just wanted to ask if that was going to show up on your forensic report. I'm like, that's akin to a cleaning company that was called out to a crime scene, calling the CSI agents and going, hey, I hope it's okay. We vacuumed up the place, and man, did the person that did this make a big mess in that place. So we cleaned all that up. Is that going to affect your report? Again, yes, the answer is definitely yes for that. So make sure that before anything happens, before you have IT or any other employees use those computers, that you send it to a company like Pathway or another company that you have a relationship with to preserve it before anything else happens. So with that, I'm going to stop and open the floor for any questions that you may have for me.
Noel, I'm not seeing any questions come through yet. Let's give it another minute to see
Okay.
if some populate here.
Right.
But I would like to share with many of our clients, as you know, Noel, now transitioning and working offsite due to the pandemic, and many of them have continued in an offsite state, being much more paperless and electronic than they ever have before. So the information you bring today, is so important with the risks that are there as we move to that new environment. And I do want to share one takeaway, Noel, that you and your team taught me that I have implemented is to resist the temptation to respond to emails off of my iPhone. Yeah. I try to work my email from my laptop because what you and your team teach, many of these things that should be apparent if you're looking for them on the phishing emails, they don't show up on the iPhone.
Right. Yeah, the iPhones they're very secure. I mean, Apple's done a really good job of kind of making those devices very secure, which is great for protecting your personal in private confidential information. But it becomes very difficult whenever you're trying to do an investigation off of that, because this data is sort of segmented off in this encrypted area that we can't get to without Apple's support. So yeah, it's a great device, but it kind of cuts both ways to it sometimes as well. So
no, we do have one question that came through. If you can take the time to answer, one of the attendees is asking, should companies pay ransomware?
Well, that's a great question, and it's sort of situational. The best thing to do really is to have backups and then have backups of your backups. Like basically have backups, offline backups versus online backups. So where we see there being issues are clients that have online backups only of their servers and of their systems, because the hackers are able to access those online backups and infiltrate those, and they take those ransom. They know that they're targeting those backups because they know if they can get that, you have no other recourse but to pay the ransom. So if you have offline backups that can restore everything as close to real time as possible, then you don't have to pay the ransom. So it is situational. Those companies that don't have those offline backups, and they are truly held hostage, for lack of a better word, to the hackers, the best thing is to just pay the ransom. And I will tell you that whenever you pay the ransom, there's a few exceptions where this isn't true, but the hackers do provide you with the keys you need to unlock your organization, because again, they want the next time that this happens, they want to be able to know that they can get more money from you. It's unfortunate, but there's people out there that make a very good living off of ripping people off. So hopefully that answered your question. It's a great one. I don't think I've ever been asked that before, but it's a good question. Thank you.
No, thank you again for presenting such important information for everyone to hear. We've got some other questions coming in now, but what we're going to ask is we'll go ahead and continue with the program, and we'll circle back at the end, and then we'll go through the different presenters today, and questions that haven't been answered, we'll just bring them up if that works for you.
Sounds good.
Okay, well, you can shift over and we'll start screen sharing as I now welcome Melanie Alpers. Many of you, I've seen the list of attendees today, and I know that many of you know Melanie well. But for those of you who don't, let me tell you a little bit about her background before she starts her session. Melanie has over 10 years experience in public accounting. She specializes in nonprofit organizations. She holds the AICPA certificate for nonprofits as well, which is an additional certification showing that she goes above and beyond in serving her clients. She manages engagements, nonprofits, all the way from, of course, initial planning all the way through report delivery and board presentations often. Her strong suit is really staying on top of what's coming down the pike and keeping our clients informed well ahead of time on changes that are happening. So Melanie's going to cover an accounting and auditing update today for us. And again, even though we're not going to be able to take a deep dive, and her session called Looking Beyond the Numbers, Melanie's going to hit on areas that are on the horizon, some accounting, an audit update that you need to be aware of when you leave this session, that you take back and say, what do I need to know about this and how does it affect our organizations? Because these topics she's covering will affect most all nonprofits. So Melanie, the stage is all yours. Thank you for being here.
Okay, thank you for the introduction. I'm glad to be here today to kind of touch base on some new and upcoming changes. And there's quite a lot happening. I know we've been through quite a year with COVID and all the PPP loans and ERCs, and of course the revenue recognition change on top of that. And I'm here to kind of look forward and see what else we can expect coming down the pipe, with 3 new standards and updates. So the first one that I'd like to touch base on is with regards to ASC 842 leases. This is something that's been in the works for a while, and it's finally almost here for fiscal years beginning after December 15th, 2022. Essentially, operating leases will now come onto the statement of financial position or the balance sheet, and that will change change the financials throughout. It'll change the balance sheet, the statement of activities, and the recognition of expenses, as well as cash flows. And I'll kind of detail out some of those changes here. So essentially, the big change is that all operating leases now get recorded on the statement of financial position as a right of use asset and a right of use liability. They're recorded at the present value of the future lease payments. And then on the statement of activities, the lease expense is going to be recognized straight line over the lease term. So not necessarily recognized first on a cash basis as it may have been in the past. So what that means is, for example, if an organization has an office lease that it's contracted for 10 years to pay $10,000 each year, essentially that $100,000 discounted to present value will now be recorded on the statement of financial position and then expensed off over time. Footnote disclosures will also change. So additional information will be required about the nature of the leases, the existence and terms and conditions of options to extend or terminate the lease. So for example, if the organization has a 10-year lease with a 2-year option to extend and expects to actually utilize that option, then it would need to disclose that in the financial statements, and additionally record the additional lease obligation for those next 2 years on the statement of financial position. There's additional requirements in the disclosures about the significant assumptions. So how did the organization determine the discount rate for the lease, the consideration of lease and non-lease components, and then let's see, and then the lease term as well. So how did the organization come up with those different factors that went into preparing the present value calculation for that future lease obligation? So in preparing for this, kind of what are some of the things the organization can do as it's looking at this new standard? I know it's still a little ways out, but it's something that could potentially have a big impact on the organization. So has management reviewed all the contracts to see what gets considered under ASC 842 as something that needs to go on the balance sheet? How are they tracked? Is it an Excel spreadsheet used? Is there maybe perhaps an accounting software needed to track all this information separately outside of Excel? And then how are the accounting entries calculated? So who's actually preparing the amounts that get recorded on the balance sheet, income statement, and how are those being reviewed. Other considerations, of course, we talked about the discount rate, which is the default discount rate should be the implicit rate of the lease, but also non-public entities may elect to use the risk-free discount rate. So there is that possibility to default to the risk-free discount rate. And so there's some considerations about how these policies are elected and how these different estimates are calculated that should be considered as the organization goes through this analysis. And of course, with the lease term, we talked about that. Are they going to have default to the 10-year lease term? Or are they going to utilize the option to extend it to 12 years? Like what is the future plans for the organization? And how did it come to those factors that it is utilizing in its calculation? The next standard I'd like to cover is the auditor's report update. So essentially, the big change is the opinion section is first, the basis for opinion section and the auditor and management responsibility sections have been changed. And I'll kind of go through those in subsequent slides, and so you guys can see examples of what the new opinion will now look like. The fourth bullet point with regards to key audit matters section, this will be something that now gets disclosed in the auditor's report. Anything, it's been described as anything that keeps the auditor up at night. So any significant estimates, unusual transactions, things that are specific to the organization that could impact the readers of the financials. So it could also include like implementation of new IT systems that have a significant impact on financial reporting, any significant areas with adjustments or estimates. So this is a new section altogether that's going to be considered as necessary that gets added to the auditor's report. So as I mentioned, the opinion section is now the first thing that we see on the report right under the heading. It outlines whether we were able to audit the financials in accordance with generally accepted accounting principles and what was our opinion as a result of that test work. So this information is probably the most relevant to the users of the financials and is now highlighted as the first item within the opinion rather than being buried further down in the report. The basis for the opinion section has also changed slightly. There is some additional information about the auditor and the requirement to be independent and their ethical responsibilities. So that has been added. That's always been the case where auditors must be independent, but it's clarified here in the basis for the opinion section. Then we have the responsibilities of management for the financial statements, where the entire second paragraph is new. So management's always had the obligation to look at the organization and see its ability to sustain itself for the next year, but now it's actually called out here in the report itself. So that's something new as well, that entire second paragraph here. And then we have the auditor's responsibility for the financials. This outlines that there may be misstatements that are not detected, which is always language that's been there, but it also kind of expands on that fraud is even more likely to be undetected, and there's some areas that there's some additional risks that the material misstatement may not be detected. So there's some additional information there with regards to the auditor's responsibilities. And I did not include it in the slide, but there's also that requirement to review going concern. on the auditor's side as well, so that looking at the organization's ability to sustain itself for the next year. The third and final update for discussion is with regards to in-kind contributions. So this is coming up as soon as June 30th, 2022. So any organizations with the June 30th year end, the next set of financials will have some additional in-kind contribution disclosures required. And because there is such a high degree of estimate in this number, there is quite a big divergence in practice as to how this gets reported on the financial statements. And this new pronouncement really seeks to streamline that and to require some additional information to make sure it's as relevant as possible for the readers of the financials. So I'm going to go through an example of what this looks like and what this new standard looks like in practice by going through an example. It's going to require the a separate line item on the statement of activities for in-kind contributions, as well as additional disclosures. So what we have here is the in-kind contribution disclosure for donated services and assets. And you'll see a lot of this information here kind of remains the same as what you would expect. The organization receives in-kind contributions. They create or enhance non-financial assets. They require specialized skill. And this is very standard in what you would expect to see typically with regards to the footnote. But then as I move further down, you'll see there's some additional breakdown of donated space, services, goods. There's just a lot more information where maybe this used to all be encompassed within one line item. It's segmented out into several different columns and charts to show the actual value assigned to each of the different components. And here we describe the valuation methodology as well as the requirement to indicate whether or not any of these in-kind contributions had donor imposed restrictions associated with them. So that is also something new this year. And then, of course, establishing the fair value. What did we do to come up with the dollar amount associated with the donated labor, for example, that was given to the organization. So just some expanded disclosures here as well. So those are the kind of three areas that are the most significant up and coming for nonprofits. And any questions, I'd be happy to answer them.
Melanie, I'm looking specifically at questions as relates to the new standards that you covered, and I don't see any of those coming through right now. So we'll go ahead and watch for those as we continue with the program. And then we'll circle back at the end during the Q&A time and may bring you back if they've got questions about the information presented. But Melanie, thank you for doing what you do so well and keeping those technical topics easy to take in and helping our attendees today to, just as a reminder, to plan for implementation. And as we always say, you can't start too early on planning. And I know with the clients that are on the call today and those that we work with, I know Melanie's telling you usually 2 to 3 years in advance of what to be looking out for as she's working with you and your team there at your nonprofit. Because again, starting early is the key. We certainly saw that with revenue recognition, and we talked about it for a couple of years, and then, well, we had some people that it was down to the wire on implementation. It was a little bit of a scramble for some of our nonprofits. So again, take this in, what Melanie's covered. The information will be pushed out to you, and please follow back up and reach out to us if you've got questions. So thank you, Melanie, very much. We'll go ahead and we'll do a little screen change here if we can as we roll into our last session. Hope you are enjoying your lunch, and I hope you're finding today of great value to be here. As we are wrapping up today, I'd like to welcome Kevin Stewart and Eric Bruce. These gentlemen today are going to talk about internal controls and board governance. So I was glad to have them presenting today because Kevin and Eric are the go-to leadership at Briggs & Veselka for all things nonprofit consulting related to internal controls, governance, operational strategy. A little bit about their backgrounds. Kevin is a principal with our client accounting services practice. He brings over 20 years of deep finance, accounting, and compliance experience. He works with executive teams and helps develop and execute operational strategies and helps really create and put that infrastructure in place across the organization. So he has repeatedly built confidence among executives and board leadership as he works with really improving the integrity and the standards of the finance and administrative functions within the nonprofit organization. It enhances management's understanding of operating results, key performance indicators, and really improves the quality and predictability of the financial information so better decisions can be made along the way. Shifting gears, Eric Bruce, as you see with us today, Eric is a senior consultant in our advisory practice here at the firm. He focuses on internal audit, enterprise management program internal controls, also process improvement, fraud risk assessment. He has over, well, I want to say, Eric, I would say 3 decades of experience.
It's okay.
Working with Fortune 500 companies. Eric's background includes Big Four firms, E&Y and PwC. But mostly Briggs & Veselka. He brings with him a broad range of experience, which includes CFO and chief audit executive roles in organizations. He has also served in leadership roles as a board member in several nonprofits. So we are so glad to have Kevin and Eric here today. And gentlemen, the stage is all yours. Thank you for being with us.
Thank you.
Thank you, Deborah. There was a lot of words there, and I think they're all true, so it's good. So Eric and I have worked together a fair amount over the last couple of years, and last year on a lot of not-for-profit work where that's kind of come to us. And so really our focus today is on how do we improve kind of the risk management from a board perspective, and if you're not a board member, how do you get your board on board with you and supporting you, and then kind of just supporting the overall organization. So the lead-in question here is, is your organization experiencing any of the following symptoms? And there's a long list here, but if I kind of break them out, you've got control issues, you've got cash flow issues, and maybe you have culture and engagement issues. And what I found, or what Eric and I both found, is sometimes a lot of these symptoms show themselves not where you'd expect to see them, which is they're showing up in the accounting function. And the accounting and finance function sometimes is getting maybe a little bit more emphasis than maybe it needs to be, because that's where all the symptoms are coming out to, right? Whether it be an issue in operations or compliance or someplace else, it kind of shows itself, its ugly head sometimes within accounting. So as an accounting function, as a finance function, as a board function, now how is it best to kind of deal with some of these symptoms? And just hitting a few here, and I've probably supported 5 or 6 clients this year in kind of this process in the nonprofit space, specifically related to risk management. And it wasn't necessarily cash flow issues as much as there was a lot of influx of cash coming from the CARES Act, and then the back office infrastructure maybe not have been ready to support that level of increase of finance coming in, which then created cash flow issues because of the expending cash ahead of time before getting reimbursed by grantors. And so there's kind of a whole series of things here that are kind of popping up, which led to this conversation here. So the question becomes, how does the board become aware of these symptoms? How is that being communicated to them? What are those meetings looking like? Are there dashboards? Are there advisors? And the last question is the board even aware that some of these things are popping out? Now, there was a specific client, which I won't name names here. There's a specific client that we worked with this past year, where there was just significant issues kind of across the board. But when you look at the management of that board, there was a committee focused on finance, and there was a committee focused on the accounting, but there wasn't a committee focused on the operation side of it, the grant management. And that's really where the risk was. And a lot of the issues coming out of that was popping up or showing itself within the accounting function. And so through the conversations with the CFO and CEO and even the board, It was educating a little bit of where the focus maybe needs to be kind of moved to. So if we go just a little bit further here, maybe, is, what is the board's duties? Without reading the details here, really the board members have a duty of care, which is making sure that they're using assets correctly, that they're including the facility correctly, that they're helping build that engagement. So it's the tone at the top here. You've got loyalty meaning that you're doing things in the best interest of the non-for-profit, the organization. And then the obedience there at the last is, it's following laws and regulations and bylaws, and specifically if you're under a grant, it's following the terms of the grant and the grantor, kind of what's being provided to you. So if we boil it all down from a board's duty standpoint, it's care, it's loyalty, and it's obedience. But as many of you know, depending on the size of the board and depending on the size of just the overall organization, sometimes I'll say board of directors, they don't really know what their role is, right? And then it's the responsibility at times for a CEO, CFO to help educate, to bring them along, to kind of train along the way. So with that, one of the things that we walk through, and what Eric and I are going to be talking through here, and really just kind of conversationally, is walking through really the risk process. And our recommendation as we're working with clients, whether it be for-profit or non-for-profit, it is really just to understand the risks, to be able to assess them. What's the operational risk? What's the legal risk? What's the financial? What is the risk? And then having a plan of action kind of address it. So in each of the instances that we've supported clients in this non-for-profit space in the last year, informally or formally, we've walked through this process. And so these next few steps, 7 steps here, kind of walking through that and talking through it, and then just some conversation along the way. But with that, step 1 really is about identifying the risk. And it's really, you can't fix an issue. You can't, praise something unless you have unless you name it specifically. And so some of the categories there that it may fall under would be, there could be governance risk. It could be external risk, things that you don't have control over necessarily. If the market changes, like if a pandemic happens, right? Regulatory risks, and that is dependent upon maybe who you're dealing with, whether it be from a tax standpoint, or whether it be grantor, the types of non-for-profit you are, financial and operational. And so kind of once you've identified what the risk type is, then it's kind of going into analyzing the specific risk. And Eric, I know we both have some stories, but I know from analyzing the risk, kind of, you might walk through that process of what that might look like.
Sure. Thank you, Kevin. And as Kevin has said, and I think really we could point to some discussion from Melanie and from Noel about the risk associated with accounting and risk associated in the cyber area as only one component of. Those are the things that we look at that need to be at least identified and determined as to whether they can be mitigated. So this is the board's responsibility, as Kevin has said, but with the assistance of the CEO and laying all this out. So we like to take a holistic approach, included in our identification of risk. Within the governance area, there's external. So we have any number of economic challenges in this era of rapid change that need to be addressed. We have funding sources that dry up. We have funding sources that appear. But the bottom line is it needs to be a holistic approach that allows us to then look at everything that's going to impact the organization. And when we look at those symptoms that Kevin shared, those are really symptoms of a risk that's materialized that no one was aware that it would be. So we like to help organizations understand what failed. Was it anticipated? Why did it fail? And are we prepared? In many cases, these are all surprises to an organization, and they shouldn't be.
And when we go through this process, the number one risk that should be evaluated, does this impact the ability of the non-for-profit to continue operating, right? How big is that? So that would be the number one on fire, burning hot risk, lava rolling down the hill type thing, all the way down to, it's an issue that needs to be addressed. So that's kind of put that off kind of down the range. And so when you think about it from and I should have a picture here, but if you think of a square, and that square has 9 individual squares in it, the top right being the highest frequency, highest significance, with certainty potentially, that's where the risk is going to be, kind of falling up and dwindling kind of on down to allow you to focus your attention as need be. If you look at step 3, it's looking at that risk as kind of Eric mentioned about, assessing and the likelihood, but then it's prioritizing, and that is dependent upon, if you think about that 9-square box, the most significant risks on the top right are the ones that really need to be addressed and addressed now. So anything that's affecting the ability for the organization to continue its mission, right? That would take priority. And so if that's with the funding source of the grant, or if you're dealing with federal grants, there's a lot more reach of the government and those types of things. But really in that prioritization, there is definitely some subjectivity there and how that needs to be addressed. And so there's a term that Eric and I use on occasion, and I think one of our last conversations, of just having a healthy tension. And healthy tension is good. And if you think about a rubber band, it kind of a stretch, and you want to stretch it to the point of not breaking. If it snaps, it can hurt you a little bit. But I think in those conversations between the board and the executives and management, sometimes there needs to be a little bit of tension there, not confrontational, not in a bad way, but there needs to be some healthy disagreement as far as, and that what that leads to is, it leads to a greater understanding of the issues. It leads to a greater understanding of the risk from both perspectives, from a governance perspective and an operating perspective. But then it allows you to prioritize which one is the most focused. And if you do that, you get collaboration there, then it allows for kind of the next steps, but it allows for a little more of a clear mind of moving forward. Now, our role as advisors, when Eric and I are advising others, our goal is really to provide clarity. We're not the one making the decisions. We're not the one implementing it necessarily, but we are the ones. And so sometimes when we're advising, we speak some pretty hard truths to people because they need to understand the significance of it. And so through that prioritization of the risk, I think that's sometimes where that clarity really needs to start coming out. And then step 4 is determining the appetite for risk. And I know, Eric, you've been a part of some different boards and some organizations, and you've advised a lot more companies than I have. But you might kind of talk through your thoughts on, that appetite for risk in the organizations.
Well, I think certainly the ability to continue as a viable organization, anything that's going to impact that is number one. But there's certain areas, particularly when you talk about regulatory risks, that a lot of organizations don't want to ever have that come up. You don't want anyone looking over your shoulder, and many of our nonprofits receive funding from governmental agencies, and they're subject to audit, and that just and subject to when I think about Melanie and InKind, some of my experiences having to look for additional funding because some InKind was disallowed. So it's really the organization's appetite is going to be driven by its mission and whether it can sustain itself. So I have many organizations that I've worked with that clearly would like to continue to do more. I mean, they'd like to do more, they'd like to serve more clients, but there's a risk to doing that. And sometimes one of the boards that I was a member of said, Eric, we just have to do it. We really just have to do it. It's on our hearts and we have to do it. We'll take that risk, but we will find additional funding sources. We've already initiated another group to go out and look for additional funding and approach funders in the Houston area, because this is a good thing to do. A lot of times, and Kevin and I discussed this, we hate to use profitable because everything good that we do in a community is profitable, but sometimes it doesn't make sense, and it drags the rest of the organization down because of its cost, not only in terms of money, but in resources who lose focus on our main mission.
And I think with that too, in determining that appetite for risk, some of those bullet points there down below is it's understanding your organization and can it support it? Do you have the infrastructure? Do you have the talent? Do you have the people? And so sometimes what happens is I didn't ask for permission to share a client's name, so I won't, but I have a very specific client in mind, and they are very much looking for partnerships. They have a scope of services that they provide. They expand that scope of services where it makes sense, but they also are looking across the road, across the Houston area, looking for partnerships where they can partner together, where maybe this other organization is in a place right now where they can kind of continue the services. So it doesn't always have to be that you're taking on the risk of doing something good. It may be making the connection to another organization that you trust and you refer to that can continue and you partner together, whether it be through a joint venture, whether it be through an informal, some sort of an informal referral agreement. But I think it really requires evaluating the current status of the organization, and that potentially impacts, money is definitely a component of it, infrastructure is definitely a component of it, talent's definitely a component of it, and then separately, it's are you exposing yourself to risks that you don't need to? And so it can be a tough conversation because you want to do good and you want to do more good, and when new grantor dollars come to you and they want to give you another $1 million or $2 million to kind of assist, I think the real question needs to ask is, are you putting the company at risk? And then separately, even beyond that, are you putting your people who are supporting you, whether it be volunteers or whether it be your employees? Is it something that they're on board with that they can do and that they'll be engaged with? So a lot of stuff there to kind of think about. Move to step 5. It's reducing and controlling risks, and so it's through these conversations, and you've named the risk, you've identified the risk, you're prioritizing the risk, you're determining your appetite for risk, and then now it's how do you mitigate the risk? How do you control them? So is that the final determination, is the risk high? Is it low? And so the board may not decide to take action, right? But by doing so, they're taking action. By not taking action, they're making a decision. And so really the goal here is the board should be taking a more in-depth look at risks that fall into the high risk category. That should be the focus of the attention. They're not taking the place of management. They're not taking the place of operations, but the goal is that they're kind of an independent view into the organization to really help drive improvements. And so that reducing a control there is kind of an aspect of having the right board members in place. It's recruiting the right board members and how engaged are they? There may be instances that there is a need for board members to go out and lobby, for lack of a better word, and connect and network and find additional revenue sources or funding sources, or just, shaking hands and kissing babies and kind of talking to folks and helping mitigate the risks internally. And so it's that board role isn't necessarily, there is a good aspect to it, but it's a job as well. And there's wisdom that's needed from those board members to help control and mitigate the risk. If you look below in that, there's that emblem that we've been carrying forward for multiple slides now about measure, assess, evaluate, management. Really, it's this entire risk management system. You're consistently kind of going through this process. Step 6 can be a little bit of a challenge, and because of the challenge, Eric's got more experience than I do, so I'm going to let him, kind of address how do you give assurance, or how do you get assurance?
Well, obviously, the board is the ultimately responsible for everything that happens in the organization. They've always been intended to be a check and balance to oversee the operations. However, there's so many known and unknown risks, and the oversight of the risk management process, or a risk management process, is the best way in order for them to obtain their own assurance. That is, getting management involved in helping them to analyze what those risks are, and making sure that they can ensure the sustainability of the organization, both on a short and a long-term basis, and as well as cautioning the board not to get too involved in daily matters. It's setting the standard. It's making sure this, and we'd like to think it's an annual risk assessment of the organization, but it also needs to be something that is refreshed as the environment changes. So when COVID came in, a nonprofit should probably have thought about new risk, probably more clients, less funding, maybe more funding, maybe new programs that they wanted to be involved in. So that's the board has to have assurance, and it has to seek out opportunities to get those. And we think that the risk assessment process is the best way to go about it. And when we say process, we mean something that's active. So when we talk about governance, we're talking about something that's active. When you govern, you're actively managing or in this case, not managing, but governing an organization because of the legal, fiduciary, and ethical responsibilities that the board has and has accepted voluntarily.
Sure. Yeah, and I'll tell a little bit of a story here, just kind of bring it all home before we go to step 7. But I've had multiple clients, new clients, reach out to me in the last 2 years, and I'll combine some stories here, but they're all very similar in some ways. Is that, and I'll go to this last year. Last year there was a lot of CARES dollars that kind of came in, so there was a lot more additional funding, specifically around housing and some other areas, kind of to assist those in need. So a lot more funds are coming in, right? So $1 million, $2 million, $3 million more. But I had, again, combining some here. So you've got multiple grants, 20 to 24 grants. In the back office, it was a little bit of a small, in multiple of these, we'll call it a little bit of a small office. Handful of accountants, maybe the processes weren't necessarily effective. There's always been a little bit of disagreement between operations and accounting. So there's a little bit of conflict there, not necessarily a positive way. There's a little bit of pointing fingers. There's some culture issues. On a consistent basis, annually, there are findings or borderline findings on the single audit through control findings of material weaknesses or significant deficiencies. And you kind of take that iffy infrastructure and then you grow by 50%, then that puts a lot of pressure on that organization to then uptick the level of support on the back office. The question becomes, do you have the money to support that infrastructure that you need to support this new $1 million, $2 million of funding coming in? A lot of times that funding, what we've seen in the last year, it's really just a flow through. And so it's not really growing the non-for-profit. It's not necessarily growing the influence. It's not necessarily growing the mission, but there's good being done, but it becomes a flow through. But with that flow through, there's a lot of transactions. And if you have questionable processes on the back end, the question becomes, in evaluating all of that, is do you have the right team in place? And so in multiple instances in this last year, and I can even go back 2.5 years, we got brought in where there's been a significant change in a CFO, the operations, there's been regulatory issues where that management and board need an independent view of assessing risk, because they've kind of gotten to a point. And so they've managed okay to a certain point in time. But by bringing somebody in independent or having, whether it be an internal control specialist or whether it be an advisor like myself or Eric or another, and there's a lot of other good firms out there that we're happy to refer to. But being able to come in and spend, a couple of weeks off and on, having conversations, interviewing all the people, kind of talking through issues, talking through concerns, reviewing financials, reviewing audit reports, just talking through things, you can very clearly come up with, I think, what is happening is the board and leadership is saying, something's not right here, but we don't know what it is. We can't pinpoint exactly. We think we might know what it is, but we need somebody. So we come in and we can basically verify. And what happens in those meetings, sometimes there is verification. I would say sometimes what happens is the issue isn't exactly where they think it is. More times than not, it's a culture issue. More times than not, there's operations issues. They're not following processes necessarily. And that accounting function is on the backside of it. But I think what can happen is, as a CFO, as a controller, as a board member, I think the goal that I'm trying to get to each of my clients outside of clarity is finance can be that glue that brings it all together. You can be that bridge. You can go out to operations and communicate understanding. You can share with them why it's important, how it impacts financing, how it impacts funding, how it impacts, these control issues, which then impacts the organization. So in my mind, my belief is accounting function, the finance function, in correlation with the board, really becomes that partnership to the rest of the firm. The communication is flowing correctly. And that can be hard sometimes. But that this view of risk really needs to reside, in my opinion, within this accounting, finance, CFO function, because they have the best view of the overall impact, because all the symptoms are most of the symptoms are coming up into finance and accounting. I'll get off my soapbox now. I'll stand down. And we get into the monitoring and reviewing risks and I think, Eric, you inferred this, is that risks change, right? It's not just a once a year thing. Risks change. I think, the pandemic, last year was significant, but risks come and go. And with that, this risk plan, I think it does make sense to do it annually, but it also makes sense to refresh it. And you refresh it by through board minutes, through board meetings, through management updates, through it should be on the agenda of the CFO, the CEO, the board members to kind of address on a regular basis. But, Eric, I guess I'd be curious what your thoughts are on some best practices or how you see the best monitoring and reviewing of the risks.
Well, I think that what we've given is a formula, and in some cases, maybe there may be difficulty in getting started, initiating this type of process. But in terms of the monitoring of risk as they materialize, I guess is really where my focus is. There needs to be good communication between the CEO, and the staff and the board. And I like to think about several things that would cause me to want to discuss with the board at regular board meetings, things that are affecting the organization currently or will, even though we may not have done a formal risk assessment or have a formal risk policy or plan. And I think about this. If sitting on a board, is there something big that I should know about? Is there something that's going to affect my future? Is what I'm getting ready to do consistent with my mission? This is something that requires a high level policy decision on the part of the board to resolve a situation? Is there a watchdog or regulatory agency that has contacted me and I have to work with? And then looking at it, and this is where the board antenna has to be up. Does my CEO need my support? And does he want and need my support? And then lastly, and I don't know what this is, but you'll know if you're sitting on a board, if you see if there's a red flag, we need to, as a board member, we would need to know about that and address that almost immediately. Some of these items are in fact red flags, but there's another red flag out there. I just don't know what it is, but I know it's coming.
Yeah, I've worked for several CFOs over the years, and being in a position now, what I share with my team is no surprises, right? No surprises. Let's have an ongoing conversation. If there's any inkling of a fire, let's run to it. Let's understand it. Let's potentially put it out, and let's bring in the team as needed. But it's not always necessary to wait until a board meeting to share with board members concerns or something that's popped up. That should be an ongoing conversation, whether it be through text or call or whatever else. You don't have to wait once a month, once a quarter to kind of go through that process. And so those conversations really should just be part of the environment, just as much as serving clients, serving the community. That risk assessment should just be part of the process, and understanding, is this the right thing for us to do in this point in time? But I think we're about up against our time, Eric, but do you have any, kind of final thoughts that you'd like to share, and then we'll wrap up here?
I can't think of any. I think we covered the waterfront, at least in terms of this. And I think getting started, as I said, is probably the hardest part, but you need to. We've seen, again, going back to risks that Noel has mentioned, Melanie's mentioned, and new accounting pronouncements that really need to be thought and addressed from a resource standpoint, from a risk appetite standpoint of your boards and the organization as a whole.
And I guess the last thing I would share is the number one concern I have for organizations as it relates to risk is burnout. And so if you have an executive committee, if you have a CEO, CFO, and that leadership function that is completely spent and burnt out, they can't do anymore. They're completely vested. And it's just, it's like you're butting your head against the wall and you can't get any, it's just a struggle on a day-to-day basis. That's when risk is at its greatest risk, in my opinion, right? Because you let your guard down, you're frustrated, you're not seeing the things that you need to see. Maybe you're controlling things at such a minutia level that you could actually drive a bus through someplace else and not find it. Maybe the focus is in the wrong place. But if a team is burned out, that risk really expands in my assessment. If I go back to my for-profit days, and I work for a large company, and the number one sign of if you go to your for-profit type, think of inventory. An inventory shrink is where you can't explain where's inventory lost. That inventory is either stolen, or it's misplaced, or there's control issues kind of on the backside of it. But the number one indicator of shrink, basically the lower the engagement of employees and staff and leadership, the higher the shrink, the higher the control risk. And we're talking about millions of dollars in inventory loss when engagement scores are really low. If you apply that for the non-for-profit group and that leadership, and it's very easy to get invested because you're doing good. But at the same time, if you're burned out, then that risk really increases and you need some assistance. And you probably need some assistance from the board to help kind of drive the things that need to happen. But with that, we'll open it up for any questions. We're available to answer any questions you have. We're also happy to have informal conversations, right, about your specific situation kind of offline. And we want to assist where we can, and we refer just as much work as we take on, because we want to make, with advisors, you need to find one that works best with you. So.
Any questions for Eric and Kevin? Eric, I've been watching the chat, Kevin as well. I don't see anything that's come through directly, but I know people are chatting right now. Let's get those in the Q&A and not the chat. And we're going to try to run through those in just a few minutes. But, as we go into our Q&A session, Eric, Kevin, thank you so much for having those difficult conversations that often need to be had with our nonprofit clients. As we know, often it's to really help them turn around the organization, where sometimes they're at loss on what it's going to take to kind of right the ship. As you pointed out, Kevin, sometimes it's not the obvious that's really causing the problem within the organization. It could be turnover in key positions. It could be because they've had changes in their programs. You mentioned the CARES Act, receiving new federal funds, of course, state funds that are triggering additional compliance requirements, filing requirements, and then maybe not having those processes in place, as you mentioned, or have the process in place but maybe not be following them. So your guidance and your leadership in the nonprofit community, though at times I know is painful for our clients to hear, we know that it helps strengthen the nonprofits, and it better positions them to continue to receive their current funding and additional funding, and therefore being able to serve the community and to carry out their mission of their organization. So thank you for all you do. We're going to go ahead and run through now some of the questions that have come in, and we've got a handful. So what I would ask, if I can go ahead and we've got the presenters back up online. So we'll just kind of take these one at a time. I'll go ahead and take the first one, because it wasn't really specific to necessarily any of the speaker's presentation. But one of the questions was, is it legally okay for a nonprofit to have a manager employed as a 1099 independent contractor and still be responsible for the financial statements of the nonprofit? So my disclaimer is going to be, when we talk about legally, legalities, I'm not an attorney. We have nonprofit attorneys that we work with, but I can tell you from a practical standpoint, when you're working with an independent contractor, it is the best practice that, one, have a written contract, so you know what those services are. Second, generally when you have an independent contractor, you're not oversighting that person, telling them how to do the work, how to carry it out. You're contracting for certain services. But generally what we would see when the financial statement, let's say closing process, is outsourced, you have someone within your organization that have the skills, knowledge, and experience to oversee that service. So it wouldn't be that the person within the nonprofit has to be able to actually prepare the financials or perform the closing process, but they need to have the ability to oversee that process. And therefore, someone internally within management is responsible. Eric pointed out that in the end, board, you're responsible. So as it pushes down to operations and day-to-day activities, we have to look who within management is responsible for the financial statements in order to be able to contract for those services. Kevin or Eric, is there anything you want to add on that one?
No, I think you hit it. I think for some organizations, it probably does make sense to have a contractor doing those financials, but at the end of the day, they're not management. They're not the governance of the overall organization. So just like for-profit clients, sometimes they hire a tax provider to do tax calculations, but at the end of the day, it comes back to the organization as the owner of that. So it really becomes, it kind of goes back to the risk conversation, right? Is that considered a risk that you're willing to accept? And in some instances, it probably does make sense to accept.
All right, thanks. Go ahead, Eric. Do you have
I would
something
say
to add?
the government funders are going to require that executive of the organization sign off on the financials that are submitted with the funding request or the reimbursement request. So ultimately, it is a responsibility of management and or the board for those financials.
Okay, all right, thank you. It's always great when you have three consultants all agreeing on the same answer. We'll go ahead and take another one. Noel, if I can kick this one over to you, please. We had an attendee today ask, it says a lot of nonprofits I know use Google Suite for nonprofits. Is that cloud service pretty secure? That sounds like an open-ended question, but can you comment on that?
Absolutely, yeah. Google Suite is it's a very secure platform. With all cloud platforms, Google Suite included, it really comes down to how it's configured. And so what I mean by configuration is the access controls policies that you have for your organization for cloud storage. So, for example, the worst offenders that we see and kind of repeat offenders that we see oftentimes is a cloud account that's been set up with a shared password that never expires. That's a no-no. And so those people have higher risk because while their data is on a cloud platform that is protected by a lot of the Google protections that they have in place to protect their data and protect hackers from accessing it, having bad policies like that or having bad access control policies will definitely raise your risk level considerably. And where we have seen issues is when they don't take those precautions to protect their data. So that's one. The other one would be to just encrypting your data before you put it out on the cloud. So if your cloud account is hacked, if the Google Suite is compromised somehow, the hacker then has to also decrypt the data that you've encrypted, which is impossible to do if you're using the right type of encryption tools. So Pathway and BNV use BitLocker, which is a tool that is part of Windows. So after Windows Vista, BitLocker ships for free with all Windows platform, Windows operating systems. So you can use that to encrypt your data before you put it on the cloud. So it provides us another layer of protection. So Google Suite is good, but if you're going to use any cloud platform, making sure that it's configured correctly is vitally important. That's something that you can have a company like Pathway or another cybersecurity firm come in and just review those policies with you just to say, yeah, you're on the up and up, you're doing well, or these are some things that I would advise you to change. So I hope that answers the question.
Okay, thank you very much, Noel. Melanie, shifting gears here, there's one question. One of the attendees today has asked if we could just comment and just briefly cover the liquidity note. I know we were looking at the updates that are coming out in the future, not looking kind of backwards, but the liquidity footnote is a fairly new footnote for our nonprofits. So could you just comment on that, really what the intent is and maybe, quantitative, qualitative nature of it just in general?
Mm-hmm. So a couple of years ago, there was an overhaul to the financial statements for nonprofits, which included the addition of the liquidity and availability footnote, which outlines the organization's liquid assets, less any restrictions on those assets. In addition to that quantitative metric, there's also the qualitative analysis, management's assessment that those funds that are available are reasonable to support the organizations for at least the next year. Is there any debt? What are the plans to pay down that debt if so? And so there's that twofold quantitative and qualitative analysis. And at this point, there are quite a few examples out there as a starting point. So that is something that in the last couple of years has been implemented.
Okay, all right, thank you. And a very usable footnote. I mean, to be able to look at it, because as you all know on the call, you nonprofits, you may have big asset number, but then when you see it's all in bricks and mortar, land, building, equipment, it really shows, what the organization has, that new footnote as far as being able to meet its expenditures for the next year. So Melanie, thank you for that overview. Noel, we do have one other question. It's kind of brief, but kind of wide open here. One of the attendees today has asked, does that mean we should not save our data in the cloud? You talked about a backup. Can you comment on that, please?
Sure. Yeah. The answer is definitely yes. I mean, I don't think it's like I said, Pathway uses and DMV also uses ShareFile which is of course the cloud storage platform, and so we use it ourselves. But again, we have those secure policies, access controls, and so forth in place, as well as permissions also enabled on our cloud platform, that in the event that that platform is compromised somehow, it limits the exposure and it limits the risk that we have. So again, with just some good procedures and policies in place, the cloud is in some ways a lot more secure than what we call in the IT world an on-premise, which means it's a server that is running in a server room on the premises of your office. So it is better in some ways than the on-premise security. So again, it all comes down to what are your policies like? How are you putting information out there? Are you following the correct protocols and so forth that are good standard practices for cloud storage? As long as you are, great platform to use, very safe and secure. So again, this is one of those things, if you want somebody to just take a look at that and review it, that's what we're here for. We can review those policies for you and give you a thumbs up, thumbs down, and help you get to a good place.
No, I'll take the opportunity while you're saying that, we can assist as needed. One of the things that keeps me up at night as an audit partner with all the nonprofits we serve is, I check the news each day, local papers, all the papers, watching, what's going on with our clients. And, anytime I see anything about fraud or cyber risk or anything, I'm thinking, does this person know Pathway and Noel and his team? So those clients that are on the call today, have it be known that Deborah Seafield is making a personal introduction to Pathway Forensic, Noel Kersh. What keeps me up at night is you have a problem and I haven't said, have you talked to Noel? Have you had a short call with them just to check in? So no commercial here, but I'm telling you, if you have any concerns, which everyone should if they don't have a plan in place, please know this introduction is getting made. I'm not going to call you out by name because I know who's on the call today. So
I appreciate the plug, Deborah.
Yeah, yes, Noel, because that's what keeps me up at night, that I get a phone call from a client and they say, we've had this breakdown, something within IT or cyber, and then I'm saying, have I connected them? Do they know about Pathway Forensics? Do they know about what's available? So end of that, but the introduction has been made. We've got just a few more minutes and just a couple of more questions. Melanie, one of the questions that came is you were talking about the new reporting standard for gifts in kind. And the question came in is, will donated services also be quantified and reported on the statement of activities, similar to the way many of our nonprofits now display in-kind rent, for example?
The short answer is yes, that the in-kind services would also be included on the statement of activities as an increased income. The line item will now be called contributions of non-financial assets. So that would include donated rent, services, food, clothing, vehicles, all that good stuff would now be considered a contribution on the statement of activities.
What about from a comparability standpoint, as nonprofits are looking to implement the new standard for gifts in kind that are rolling out, those that really are trying to get ahead of the curve? Can you comment on that?
So this accounting standard is retrospective, which means we would go back to the prior year and also update the financials as needed for, in this case, we're looking at fiscal year end 2022 clients having to implement the standard. So we'd go back to fiscal year end 2021 if the financials are comparative.
Okay. I guess one option, sometimes what we see happens, as you know, with our nonprofit clients is if there is a new standard and it is significant, and this may or may not be depending on the nonprofit, the gifts in kind disclosure, but we do from time to time see when a standard is adopted, the client will say, for this year, let's just present a single year presentation on the financial statements instead of fully comparative, because I don't want to go back and recap that information for the prior year to get to fully comparative financials. So again, we only usually see that, when our clients have a significant standard, and it would be a lot of work to go back and recap the prior year as well. I'm checking. I think we're at about 12:26, and I believe we've got all questions answered. Again, for those of you that are seeking continuing education credit for today's session, that information will be sent out. The certificate will be sent out after our firm compiles the information and compiles the polling questions and looks at the attendance. And so those will come out after we finish up day 2 of the boot camp tomorrow, so that can be done all at the same time. It's hard to believe that we are already done. This is a favorite topic for all of us on the call today, talking with nonprofits, and hopefully today has been a great way to reach many of you with good information. Again, whether you're large or small, it really cuts across all nonprofits in our community. I do want to say that tomorrow we've got a great group of speakers as well. Our agenda tomorrow includes Luke Redus with Compassion United. Luke is going to be discussing volunteer engagement. We understand how important that is to each and every one of you and your organizations. From Briggs & Veselka tomorrow, we have Jonna Kelly and Angie Armstrong, which many of you know, on our tax side and our client accounting services side, that are going to be covering the employee retention credit, ERC, that we all have had front of mind, tax updates, and of course, all things PPP. Additionally, tomorrow we've got the Wolford group that will be with us. Brooke Baugh will be with us, and she's going to be discussing virtual fundraising. So tomorrow is going to be a great program as well. And again, you can continue to earn continuing education tomorrow for those of you that need it. And hopefully you found today of great value. Again, I'd like to round of applause for all of the speakers today. Y'all did a phenomenal job. Thank y'all for being with us, and enjoy the rest of your day.
Thank you.
Bye-bye.